Hello everyone and welcome to today's webinar, Demica Insight Q2 2022, Corporate Value Creation in a Challenging Economy. Before we get started, I would like to go over a few items so you know how to participate in today's event. You've joined the presentation listening using your computer speaker system by default. You'll have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of your control panel. You can send questions in at any time during the presentation. We'll collect these and address them during the Q&A session at the end of today's presentation. Today's webinar is being recorded and you'll receive a follow-up email within 24 to 48 hours with a link to view the recording. I'd now like to introduce Matt Reeford, Demica's CEO, to begin the webinar.
Hi, welcome everybody to this month's webinar. We're going to cover two things off today. The first is, what does Demica's Q2 platform data tell us as what's going on in the macro economy? In prior webinars, we've been looking very much over the year-on-year trends, seeing whether the surge or depression of activity due to COVID has finally ended or not. In this webinar, we're focusing much more on the last 6 months in 2022, as in H1, and we think that's really interesting data because there's obviously been substantial amounts of inflation coming into the system in the past 6 months. And what we'll be showing in the data is how we see that in different sectors and, what does that mean? At that point, then, that'll be a discussion between Alex and I. And then we're moving on to an investor perspective. We're very fortunate to have Alex with us, and I'll allow him to introduce himself in a moment. But we're going to be looking at three different things when we look at the overall. What's going on in the public markets at the moment? How are they reacting to the inflation and other macro factors that are going on? Second, will private markets react differently to the public markets? And therefore, what's the impact of that onto working capital finance and the role of non-bank funders within it? So that's today's webinar. Please interrupt us if you've got questions. Please put them into the chat, and we'll, it'll go on from there. So a little bit about me. I'm the CEO of Demica. I've been running the company over the last 7 years, having helped acquire the firm back in November 2014. Prior to that point, I was the group CEO of IPGL, the holding company above ICAP, the world's largest interdealer broker at that time, and I have a broad range of financial service and fintech roles prior to that point. Alex, over to you.
Yeah, well, first of all, thank you for inviting me. So my name is Alex Veroude. I am the CIO for fixed income at Inside Investment. For those that don't know Inside Investment, we are a very large fixed income asset manager that specializes on institutional clients. So we overall manage around a $1 trillion portfolio on behalf of our clients, which is a combination of investing in traditional fixed income assets, private fixed income assets, and also derivative fixed income assets, which which are all going under our LDI strategy. So I've been with the firm for 15 years, 8 in our London office, and the last 7 years in our New York office.
And you've had, before we get into the detail, Alex, you're very unusual, at least in our experience, is that you've been looking at working capital finance in corporates for a very long time as a non-bank investor. What triggered you to be interested in this space?
Yeah, so I'd say, yes, we kind of have to think back, maybe around 2012 or something like that. We started looking on behalf of our clients at non-traditional fixed income investments, and we looked at pretty much anything that looked particularly attractive from a risk return basis. Trade finance in its widest sense shows up as being very attractive risk reward, because for starters, the risk is actually not that big. The maturities typically are very short. So versus public investments you can make for those short maturities, this is potentially hugely attractive. And we've since 2012, been investing, in this space. And I think we might be discussing how much and what we did at some point later. So I'll leave it there.
Okay. Well, thank you for that context. So let's kick on now to talking a little bit about what we're seeing in our data and the economic trends. I'll be slightly putting you on the spot, Alex, because you've had about 30 seconds before this webinar started to see what these slides say, but it'd be fascinating to get your observations on the sectors that are going to be coming up and whether they reflect what you're seeing as well. So what you're seeing, if the audience who don't know our data, is the face value of a constant group of suppliers, of the value of their invoices rebased back to 100. So all other things being equal, it's effectively the nominal in terms of their volume. So it reflects both the unit price of the goods, but also the amount of goods sold. The red line shows you for computer hardware, particularly in the areas of laptops and printers and peripherals, and also sort of electronics for industry. And it shows a very strong seasonality, etc. One of the things that's quite unusual for us is, and we haven't shown in this chart, we have in prior ones, is it's still tracking to the same volume as it was throughout the last 2.5 years. So there is no real change, no drop off yet for the demand for technology equipment. I don't know whether, Alex, that surprises you or not. Would you have thought by now, effectively, that demand has been pulled through the supply chain?
Yeah, I mean, I'll first of all take a step back, Matt. Right, I think this data is absolutely fascinating, and the reason I'm saying this, just 20 minutes ago, the US released its second quarter GDP, and the market was expecting a plus 0.4, and the US actually reported a minus 0.9, which actually has a lot of people, you know, the 15 minutes that me and my team had to go over what's going on, right? So the data feels very inconsistent. The macro data feels very inconsistent. So everybody's trying to figure out now what's going on. You know, where's this coming from? So for example, you know, goods have declined. You know, the GDP for good component is down 4%. Now, obviously, you know, this is only for the period, you know, until June. So if I look at this graph, for example, computer, electronics, and appliances, it's kind of saying, you know, this might be a temporary situation, right? So that fall in goods, you know, that we saw for the second quarter for the US, if your data, you know, is spot on, then we effectively should be expecting a quarter three recovery of that good consumption, and therefore I find it really fascinating in terms of how leading could this data be, because there is just no other data out there at the moment. And I did have a sneak peek. You showed me a couple of the other pages as well. I think there's something even more fascinating on some of the other pages there. So, but obviously I've got lots of questions on your data. As soon as you start supplying interesting data, you know, the questions start coming. It's like, hey, God, can I have more data? Because I'd love to dig, and my team would love to dig a bit more.
So yeah, no, as people know, the data belongs to our customers. We aggregate it, anonymize it, we don't sell it, but we've used it for the purposes of education and working with our customers to help them see value for working with the platform.
You might have another business line at some point if you were allowed to sell it.
Well, maybe you should start using our platform, Alex, to finance your other program. And you can have the data. I think the tier one automotives are really interesting because this is European supply chain. We're very strong on the supply chains running in northern Italy, France, and Germany, right? And we know, everybody knows, there's a lot of supply stress in those chains, right? They're really struggling to deliver the end piece. So we don't think we're seeing volume here. We think we're seeing price inflation running through.
Yeah, exactly. And that's the question as well that we briefly debated before we started this chat, right? It's really hard at the moment with inflation running so high. You know, even, you know, statisticians have issues like, okay, is this unit growth? Is this price growth? What's going on here?
Yeah, so it's hard to judge. And one of the things we've been doing, as you'll see later on, is we've been thinking about how consistent is it with some other indices like commodity pricing or freight rates and things, because that helps inform a little bit about what we're seeing. If we move on to the next slide. What we're looking at here is metal manufacturing. So this is after the smelting processes have been completed, and that people either refining base metals or manufacturing very basic level parts. So the very front end of the manufacturing supply chain in metals. So this would be almost tier 3 suppliers in automotive or value added refining. And then you've got chemical manufacturing, which is principally over in sort of things like fertilizer, naphtha, bulk chemicals, far less speciality, and there's no pharma at all in this data set.
Yeah, and then just commenting on that one from what we know from the macroeconomic data that is out there, we obviously knew that, you know, the chemical industry was having a pretty decent time of it, you know, in the beginning of the year. The management teams in the chemical industry then started reporting that conditions aren't quite as great as they were anymore, which is also in that data, right? You see from May onwards, you know, that decline. Having said that, you know, the impression we as investors got from listening to the management teams of, you know, various large and small chemical companies is that it was worse than the data that you're showing. If your data is correct, then I'm kind of like, actually, it's not as bad as the management team said it was. So that might actually lead to a positive surprise when they kind of come to talk to the market again in a few months.
Or our data isn't sufficiently representative.
Yeah, right? And that I think exactly right. So that would obviously be the question: is like, how many companies do you have? And even if you have a few, that's fine. But how consistent are they? Are they consistently loading up all of their invoices, or are there from points in time where they decide that, you know what, this quarter we had some else going on, and there were some invoices that weren't going through your platform, and that's the reason for the decline?
If we're doing seller-led transactions, so receivables finance, we will have all invoices irrespective of whether it's been financed. And if they're the suppliers on a buyer's supply chain program, again, we'll have all of the approved invoices irrespective of whether they've been financed. So the data set is quite consistent on a supplier level, as in who's actually produced.
Well, that's good news then, right? Because consistency of data is more important than the breadth of data. I mean, you're never going to cover all of the chemical companies. So I'd rather have a sample that is consistent, because you can still draw conclusions out of a consistent sample than having an inconsistent, very large group. So I'm still interested in your data.
Yeah, and it's, for us, we find it fascinating. The bit that I looked at this was I overlaid these charts on the price of oil and the price of iron ore as a sort of proxy to the input prices for these firms. And there's quite close correlation. It looks like these companies are getting very good at passing on the underlying raw material costs through to their customers.
Are you trying to make a pitch for a quant hedge fund to really want to buy your data?
No, I wouldn't want to do that. No, we've been approached by more than one. But yeah, this I thought was interesting. We know there's significant working capital pressure building up in these supply chains, right? Because your input and output costs with the manufacturing lag times is quite significant, right? They're having to finance 40% more of what's going on. The other thing we're seeing is that the traders who are supplying into, or one of the suppliers for the materials into this space, they're also under much more significant working capital pressure because what they're having to put onto margin, their price exposure on exchange has gone through the roof, right? There's been significant both price increase, but also volatility has increased. Both those drive the margining requirements. So the working capital stress starts at the beginning and is now reflecting all the way up these chains.
Yeah.
Now here's one that's sort of more divergent. I don't know what your sort of thoughts are on this. This is food, both food production. It's not people who are not growers. It's not farmers. It's people who would be processing raw material foods, say flour and things like that, as well as overlaid into it those that run perhaps wide, high volumes of restaurants or things like that. So that, but at a basic level, so not fine dining.
Yeah, I think this is actually one of the most interesting ones for me, because if we look at that US GDP data that was just published, right? So one of the interesting trends is that goods consumption, appliances, etc., is down 4% for the second quarter. So in other words, consumers seem to not be spending money on new fridges, etc. Now, you mentioned that transportation and logistics includes companies like XPO, etc., all these last mile deliverers, right? So if you order a fridge, it typically gets delivered by those guys. Now, what you're seeing in that data, or at least the way I'm interpreting it, is that actually there's a recovery from April to June. More stuff is being delivered, at least in value terms. So that's quite interesting, because that would kind of indicate that fall in, durable consumption that you've seen is not going to last. You're going to see a better, outturn for GDP. But again, it comes back to how many people are in your sample. Is your sample skewed to one or two countries rather than other countries, etc.? So, I've got more questions, but I do think it's fascinating data.
Yeah, that recovery is interesting, because we originally felt that this was principally showing container freight rate drop, right, which is down 30% from peak, right? So peak at the start of the year and is coming down rapidly as and obviously container freight rates predominantly sea or maritime transport, and our data set is predominantly land. But we wonder whether there's a correlation to a degree in it. But the recovery, is it price or is it volume? It could be volume, right?
Yeah.
To your point, and in which case that's quite an interesting statistic.
Yeah.
So that's, let's look at our crystal ball again in another quarter. If you're interested, I might ask you to come back and we can see how these ones play through.
Yeah.
I'm happy to speak to you another time about what sits underneath it a bit more.
Yeah. Okay. Cool.
So let's move on now to talking a little bit more about the public markets. You're obviously, as a firm, massive investors in public fixed income. And I suspect many people on this call would be interested in your view as to what does rising interest rates mean, and rising inflation, non-transitory inflation, mean to credit spreads in the public markets. Where's this leading us?
Yeah, and so the big debate, not just with us but with all investors, has been recession, yes or no. This increase in inflation is doing well. First of all, it's putting pressure, obviously, on real consumption that consumers can display. Secondly, it's causing central banks around the world to tighten policy quite dramatically, putting even more pressure on not just the consumer but also on corporates. And effectively, the central banks need to cool down inflation. The only way, really, you're going to do that is by making the economy slow down. Now, slow down enough to go into recession. That was the debate prior to the GDP release today. Now, purely technically speaking, we now have in the US 2 quarters of negative growth. So I'm sure that people are going to say technically we now are in a recession. So that debate might be becoming a little bit less relevant as it's getting settled in favor of recession. Now, what clearly does recession mean for credit spreads and financing conditions in the public markets? We expect them, to stay wide and potentially edge wider still throughout the year, which in turn is going to put some pressure on management teams of companies. Now, they all benefited over the last 5 and 10 years from extremely cheap rates in the capital markets or in private markets. That is over, right? And yesterday, the Fed obviously hiked 75 basis points. That wasn't surprising. What was a little bit surprising is their insistency on the 2% inflation. They're basically saying we want to get back to 2%. That would imply a lot more interest rate rises. potentially a lot more pain for people, and not just consumers, but also corporates. So I think all corporates need to start preparing for a potentially prolonged higher interest rate environment. And when cheap debt comes up for refinance, and that could be, in 24, it could be in 27, but it's very unlikely you're going to be able to replace the debt you had with debt that is equally cheap. There is going to be a penalty. You're going to have to pay more for that. And I think that's a really interesting challenge for management teams over the next few years.
And I think if you overlay with that your comments about recession and therefore greater financial stress or poorer performance in any event, that's going to overlay it even more.
Yep. Yeah.
And
so our view on this is going to be a management team challenge, right? I think our view is that the last decade, if you're a management team of any corporate out there, it was relatively easy to manage. Now you're going to have a much more challenging environment, and you're going to have, management teams that really know what they're doing, that evaluate their options and act fast on them, right? It's this is going to be the real deal, and it's going to be interesting.
And I think that, if you think about what we're seeing on the supply chain side, right, those supply chain shocks, changes in pricing, change in channel that they're managing on the physical level, right? It's going to be hard for the ops and procurement teams as much as it's going to be for the finance and sales teams, right?
Yeah, and for example, one of the things we've been kind of saying at our end, right? If you're a management team and you're facing inflation, right, a lot of inflation, I call it 10%, you're obviously one of the biggest bets you can take is, as your input costs are rising, just buy the input cost now, right? Because they'll be 10% more expensive next year, right? So in other words, start loading up on, materials, but that's a massive increase in working capital. If you correctly assess what you think you can sell 12 months down the line, then that's great. That's just temporary working capital. If you misassess the situation and bulk bought stuff that nobody's going to buy from you, you basically go bust. So this working capital management is going to be really important, in the next 12 to 24 months.
And that also suggests that inventory finance is going to become a much greater part of the market. It really hasn't been a significant outside of sort of commodities and oil and things, right?
Correct.
People have run just in time. You're right. We'll see a spike on the inventory side. Certainly in our own sales pipeline, we're seeing much greater demand for it, despite the fact that inventory finance on a cost perspective is much greater than receivables finance. If inflation is running the way we're discussing, then it makes sense.
And typically we haven't done, and I'm just talking about a bit what we've done, we haven't done a lot on inventory finance, right? Inventory finance is a little bit riskier for an external investor sitting there, right? You've got quite a bit of obsolescence risk, technology risk in inventory finance. And quite frankly, the management team of the company knows a lot better what the inventory is worth than we do. When you have inflation and it's running at 10%, inventory finance becomes a little bit more acceptable, right? Because there's technological obsolescence, but prices are rising 10%, right? That buys you a margin of error. So I think we're going to be more interested in inventory finance over the next year or two.
That's a really interesting observation. And if you think about different sectors, what sectors are interesting to you at the moment, and which ones are you guys very cautious about?
Yeah, so, and I guess it's not something that so one of the big picture worries, of course, well, actually maybe not of course, but the rising interest rate environment, call it the rising discount rate environment we're seeing. So the more exposed you are as a management team or, as a business proposition to a rising discount rate environment, the more cautious we get. So there are businesses that are very exposed to discount rate rises. For example, infrastructure, real estate, etc. If your discount rate was 3%, for a long time, and you have effectively assets that are 30 years or longer, this is a massive hit. So we kind of prefer faster turnover companies, asset light type of companies in this situation, because there is an asset revaluation going on at this point in time, which is a big contrast from what we would have wanted, 2 or 3 years ago, right? Then asset ownership, security, etc., was like, okay, that's what you want. Now it's a double-edged sword. So there's a big transition on the way in terms of how to think about the world when you have double-digit inflation.
But if you overlay to that your observation about consumers, right? Fast turnover businesses, a lot of them are more consumer orientated, right?
Correct.
But spending patterns are changing quite quickly at the moment. Do you just take the view that because you're in for the longer term and you're making more, cyclical bets, that you'll wear that type of risk? Or are you being cautious on the consumer side as well?
We are cautious on the consumer side, but for the time being, the consumer's still in a pretty decent shape. So for example, one of the interesting things in the GDP release was, again, consumers are still spending on services a lot. Now, obviously, you see that because everybody is in a line in Heathrow, trying to go on a holiday, right, and booking a place in a restaurant. So the consumer is still willing to spend, on it. Now, the question is, how long are they able to spend? They might be willing, but how long are they able to spend? But more importantly, consumer-facing businesses, always kind of good management teams can make phenomenal stories in consumer-facing businesses. So we want to be aligned with successful management teams more than anything else. The difference between a good management team and an average management team is going to be huge in the next few years. So that's what we're not saying. We're not going to be in it. We just want to be with the right management teams.
So that suggests that from an investor perspective, you'll be moving away from tracking closely to indices and being
Correct.
much more selective.
Exactly.
Okay. And that's the public market side, and obviously some of the comments you've made are relevant to the private as well. I'd be just interested in your perspective. There's been a big push from investors into the private credit markets over the last few years. How do you think that's going to change going forward?
Well, there's two answers. Structurally, I don't think this big trend is changing. If I look back, if I look at our client base, our clients are still far too liquid for what they actually are trying to achieve. They're long-term investors. Why they own liquid, investment grade or below investment grade bonds, sometimes the reason isn't obvious to us. They want the return and the risk profile, but they don't actually need the liquidity. So therefore, I do think this ongoing move of swapping, liquid assets for illiquid assets, equity, public equity for private equity, public debt for private debt, I think that trend will continue. Now, it will slow down, because one of the things you typically see in public versus private, and we're very active, and we're one of the largest investors to equalize private and public markets, because we invest in both of them and kind of look where the conditions are best at any point in time. What you see often is that when public markets go and reprice, i.e. equities fall, 30% and bond yields rise 2 percentage points, private markets take longer to adjust. And then you can get an inverted structure where on paper, private market yields are now lower than public market yields. Private equity market valuations on paper are higher than those of public market ones. Obviously, that cannot be true, right? But it takes some time for that equilibrium to come back. Again, that's what is happening now, right? So in the first half of 2022, you saw public markets go for, a fall. private markets are working through that fall. Sometimes management teams get misadvised by investment banks, etc. Right? It's like, oh yeah, you can get this type of yield and financing cost in private markets. Obviously, maybe there are some investors that haven't gotten on that world has changed, but generally you cannot. So, it's those management teams that come to us, for example, and say like, hey, we understand you guys at Insight basically provide financing at 3%. Well, we might have done in 2021, but we're not in 2022. So,
and out of curiosity, how much has it moved by? If it was 3%,
it's moved quite a bit right now in terms of overall yield. It's moved quite a bit because obviously interest rates have moved by anywhere between 150 and 300 basis points, depending on which country, what part of the curve you're in. On top, credit spreads have moved. They've not moved that much, but they're pretty much, about 50 to 100 basis points wider. Now add them together, and you do get a bit of sticker shock with some management teams, right? Where they go like, wow, you know what? You're ripping me off. You were 3% last year, and now you want 6%. Like you're criminals, right? We're not criminals. We're just pricing through what the market is basically what the going rate in the market is. Now, I do think that if they look at, and this is actually going to be interesting, right? So what we're getting ready for on the private side is at some point, you'll see public markets closing. Public markets are a brilliant way of executing a financing, right? It's cheap, it's large, but it's not always open, right? And the environment that we're expecting over the next 2 years is a less open public market environment. And yet, you're going to see companies needing more financing. So therefore, we're effectively getting ready for fast, relatively cheap, but not as cheap as it was in 2021, but fast and relatively cheap, capital in private markets to kind of say, hey, you know what, dear management team, you wanted to issue a public bond, securitization, whatever you wanted to do. That turned out not to be possible. You still need 200 million. Let's do a deal and let's do it fast, right? Because you want your working capital. Let's get on with this thing.
And I think that's an advantage, though, that Insight has given your institutional customer base of insurance companies and pension funds, right?
Yeah. Correct. Yeah, we can act in with large size, and we can act fast. Now we're not the only one, right? I've actually seen 1 or 2 private deals of meaningful size already being done at the moment, particularly with companies that have temporarily been shut out of the public markets. But that's a trend that I expect to see more.
That's interesting. One of the things that we look at when we think about non-bank financial investors versus the banks that are operating in the space is that the way that each group price credit is very different. Most of the banks that we work with price on the basis of what are the credit losses that they're likely to have, and then from there, looking at the pricing on top of that base, where you're looking at an alternative price. What is your alternative uses of capital? So what does that do for whether or not you can distribute bank assets or bank originated assets into non-bank investors like yourselves?
Yeah, you're absolutely spot on. They're really different approaches. Now and you can get, sometimes we can be cheaper than banks, and sometimes we're like way more expensive than banks. Generally, I think one other discussion, right, but I'll leave that to you, is, are banks and non-banks competing? Because they're not always, right? There are some symbiotic relationship between banks and non-bank investors. But don't forget, banks themselves, are also corporate entities with management teams and strategies, etc. So what you typically see with banks is they're also not super consistent investors. As credit losses or capital, become scarce at the bank, you often see them turn off the buying and actually in some cases turn from buyer to seller. Now some become public sellers, i.e. it's on Bloomberg and Reuters and all of that, those news stories. Some are sellers very quietly behind the screens because they don't want to upset their customers and all of that. But we do expect a slightly more challenging environment for banks, not nearly, the kind of 2008, 2009 crisis. Banks are actually very nicely positioned at this point in time. But as, banks, and particularly the risk management teams in banks, are upgrading their forecasts for credit losses because, for example, they are now also expecting a recession, or because their CEO has been very publicly saying that, they expect an economic hurricane, then, we expect some of that, higher expected losses, to come through to their pricing as well. But you're right, as a management team, my only tip would be, and we sometimes are very transparent with management teams that want to borrow money. It's like, listen, you should check out alternative options away from us, right? And even away from non-bank lenders, because it's your job to get the cheapest financing.
And I think personally, from what we can see in the markets, obviously we talk to about 250 investors at the moment. I think the gap between bank pricing and non-bank pricing has widened significantly in the last couple of months and is going to widen much further. The adjustments for banks in pricing credit, particularly at the short end of the curve, right, and the stuff that we do, doesn't tend to move very much. But you're seeing 50 to 100 basis points pick up in yield, right, on spread.
Yeah.
The other things that you're doing. Well, you put that through a working capital product, and that makes it very significantly different, priced differently in your world from the bank world.
Yeah, at the moment, I'll freely admit, right, at the moment, the way we price, we're not super competitive at this point in time. And I'm talking, really the months, between May and now July, we've not been super competitive. To be honest, we don't mind that at this point in time because we see enough opportunities in the public market. Doesn't mean we're not interested or we've made a strategic change out of this market. We're still strategically very much there. But we have our own pricing discipline, and we're sticking with that pricing discipline.
And that's something we've seen. It's, as you say, it's quite recent that it's widened out. And the other thing that we think we're going to see is challenges in banks risk distributing assets to non-banks. Right, there's been a big trend in the last sort of 12 to 24 months, right? Previously, risk distribution market on these programs was bank to bank only, and we've been increasingly seeing non-banks buying down from banks. But the price that the original program has been originated at, particularly, which will not be adjusted for some time, right? If the supply chain program was only put in place 12 months ago, the banks are very unlikely to reprice the credit. That's going to make it much harder for people like yourselves to be interested, I suspect, in sub-participating.
Yeah, you're right on that. But at some point, right, there's two ways for the banks to reprice, either because, effectively, they adjust their pricing upwards, or the other very simple way is they keep getting hit, right, by borrowing teams and go like, okay, you know what, you guys are the cheapest, there you go, we like to borrow $1 billion and another $1 billion and another $1 billion. At some point, you're going to run out of balance sheet.
This gets back, at the heart of it to what type of recession this is going to be. Will there be significant credit losses incurred by investors or not? Right? Probably a little early yet to know.
Yep. No, but if you can use your data and give me the answer, then we can make some significant returns for our investors.
Asset managers are often seen being a little bit like fair weather friends to management teams, right, in the provision of credit. Is that fair, do you think? Or are you more relationship orientated than the perception? Sorry, your perspective, not insight specifically.
I can see where the perception comes from, right? And I'm not going to say it's not true. Asset managers can be fickle, right? It's not because they're fair with their friends. It's just because they move to a different rhythm. So, so for example, banks, drive on relationships. We don't drive on relationships with borrowers. In fact, one of the things that we very consistently say to our investors, right, so the clients that we act for, is that you can't serve both sides at the same time. You can't say like, hey, dear borrower, dear management team at borrowing company, we're your relationship financing solution, we'll always be there. And at the same time, go to a pension fund or insurance company and say like, oh yeah, we're always going to make the best investment decisions for you. Those two do not always match, right? Sometimes the best investment decision may be to not finance that borrowing management team. Now, obviously, that's going to be very upsetting to the borrowing management team, right? So we have to pick who is our client base. And as an asset manager, our client base are the people's money that we invest. Banks on the other end side, often say our client base are our borrowers, right? We will be there for you come what may. So yes, that if I were a management team of a borrowing company, I'd go like, you know what, that sounds much more reassuring, right? That my bank will always be there.
So maybe the phrase "fair weather friend" is unreasonable, but it sounds like you think there's a degree of truth because it drives and motivates.
Yeah.
So that's, and which I think is a neat segue if we start narrowing the discussion a little bit more down into working capital finance, right? Which is an area obviously where Demica is entirely focused on. What role do asset managers? What role are they going to play in the years ahead? And what role have you played up till now? And do you see yourselves as complementary or competitive to the banks which currently dominate this market?
I would say in reality, we've been complementary. Right? We have, there's been a few situations where it's competitive, but by and large, it's been complementary. Right. So one of the things that is quite challenging for non-bank investors, it doesn't matter whether it's a hedge fund or, a real money investor, like, we are. But one of the things that is quite challenging is the constant fluctuation of the invested base. Now, but that's the definition of working capital, right? That's why you have it. Our ideal investment is one that, is always fully utilized, right? You know what? Borrower comes through the door, basically draws 100 million and basically keeps the 100 million, very nicely drawn for the full 3-year facility. That's impossible, right? But one of the things that you can do, with working capital is analyze it a bit more. And you guys have been very good at almost pioneering this, is kind of saying like, listen, there are bits of working capital which are much more stable, and then there are bits of working capital which are much more volatile. And we have a better bid. Non-bank financing firms have a better bid for the stable bit part of working capital, and we have a god awful bid for the really volatile stuff. Because in the end,
you don't have a bid at all for the really.
No, in some cases we don't, right? And it's very practical. Like, for example, I'll give you a practical example. And we have kind of encountered this over the years of working together. Is if we make capital available for the really volatile stuff, i.e., say there's an availability of 100 million. Right. Obviously, we have to set aside 100 million of client money, because if this borrower turns around, on Friday afternoon and says, I really need 100 million, it's got to be there. So we have to take 100 million of pension fund money and reserve it, set it aside. Now, the pension fund's then asking, like, okay, great. Yeah, I've got 100 million. What return am I getting? And if we then say, well, nil, because we don't even get paid a commitment fee or an undrawn fee, or it's really tiny, pension funds going like, are you idiots at Insight? You're supposed to make the best returns on our 100 million. So that's, so if we even try to be at that front end of working capital, then, we're going to, you know, and you guys understand it, but sometimes, you know, we get accused of like not getting it, right? We say, like, well, we need a commitment fee, we need an undrawn fee, etc., and we get basically told to go back in the bush where we came from. It's like, that doesn't work, right? You don't understand the market. And at the same time, our answer is, you don't understand our client base.
And I think that's why you got the non-bank financial market and the asset managers specifically within it are complementary to banks, partly because one can put facilities together where one can have a bank sitting alongside you, taking more of the variability in the facility. Yep. But also, I think if we look at credit risk, I think our non-bank partners are without doubt much more competitive and flexible and thoughtful as we go down the investment curve, right? Getting
Yep.
into the sub-investment grade space, where pricing then becomes much more benchmarked to the public markets and less about relationship pricing.
Yeah, no, exactly, right. And in some cases, right, that symbiotic relationship we've seen. So sometimes when a bank, because banks are almost the opposite, right? It's kind of like, please don't draw my line consistently, right? I mean, we don't mind you borrowing on Friday and paying it back next Friday, right? That's what it's there for. But if you're going to constantly have 100 million outstanding, banks get a little bit queasy, right? They go like, everything okay with you guys, right? You need to borrow a lot of money. That's where we then can come in, you know, if things change and say like, you know what, this looks like it's now a little bit more permanent. Let's just take, you know, some of that money and transfer it from the variable part to a little bit more stable part. Now, either we can do that with you guys, or we can do it with a bank behind the screens.
Right, and people are using our platform, the bank's using our platform to do more risk distribution, because if we're running the primary side of the program, it's very easy for us then to handle their onward sale on the other side. So we see what you're describing firsthand when we're setting up the risk distribution side for some of our banks.
Yeah, and that is actually, you know, and I have to say, I'm not being paid by you to say any of this, right? But that's the beauty of your platform, right? We know it, the bank knows it, right? You're independent, right, from that. So it's kind of like, okay, great. Because obviously our biggest concern is if we're transferring risk, you know, from a bank to us, it's like, uh-oh, right, what system is this sitting on? And how do we know that all the data in that system is actually correct and there wasn't a fat finger error or anything like that? Yeah. So you are a facilitating platform for those type of trades, absolutely.
Thank you for the product endorsement. That's much appreciated. But that is correct, obviously, right? We see having the data passing through us that's in a consistent and scaled form makes a big difference, particularly risk distributing the more complex pools of credit risk, right? The single names is a different game. I mean, if you think about, you know, we touched on it a bit, and I'd like to sort of pull you back to your observation around inventory finance. This has been an area that banks have been less interested in, right? And you made an observation, you thought potentially Insight and others will become more interested in inventory finance now. Perhaps you could just sort of walk us through a little bit more why that would be the case, and what would look attractive to you if somebody was bringing inventory finance?
Yeah, and I can give you kind of an example of some things that we looked at in the past and which is too hard for us. You know, and many years ago, you know, somebody kind of came up and said, like, you know, it's like, we've got, I don't know how many handsets, mobile phones, right? You know, this is sitting somewhere, right? These are hundreds of thousands of handsets. You know, they're pre-stocked for consumers to buy, right? So there's high turnover in this inventory. Here's the list of all the phone models, etc., right? Here's the value of it, and it was pretty enormous, right? It was like 500 million or 700 million of phones, and you go like, wow. I mean, phones, you know, kind of become obsolete pretty quickly. We do not know how quickly it's going out, and our worst, you know, our worst case would be like, gee, we're stuck with like 1 million handsets that are completely unusable, right? And we're the idiots that have to write them off. So that's the type of stuff that's really hard for us to do, because there's an information asymmetry, right? the current owner or the producer of the inventory knows a hell of a lot more about this, right, than we do. So you got to overcome the information asymmetry, and there are some ways of doing that. But then also, what is the trend, on the price of the inventory, right?
Yep.
And there are some inventories that are naturally declining price, handsets being one, right? Only a few months too many, and this thing halves in price. There are things that are broadly, unchanged. Most of the commodities, etc., like oil, soft commodities, etc., that's a broadly unchanging. And then there are things that are, should go up, in price as you hold them. Now, those are very rare. There are not many of them. But with inflation, you're going to potentially see more of those type of inventories, right? So, for example, I just was sitting in the train this morning. I was reading that Nestle is increasing the price of Twix, yet again. So you know what? Twixes are now appreciating assets. That makes financing Twixes.
For the 8-month shelf life, and then they've
Exactly.
Any questions on the channel at the moment?
There's one. I think I've passed on to you. I can read it out.
I'm not sure I see where they are. Observation rather than a comment, but in the leveraged loan market, investors have segmented between private debt and institutional investors taking term loans, which have become more difficult for banks and the RCFs remaining with the banks to fund working capital. Any observations on that one, Alex?
Yeah, it's actually the same is happening, not just in that, leverage loans are effectively corporate debt, right? But that same concept is working, in other markets, trade finance, as well, real estate finance, or, for particularly, kind of development capital. It's the same thing you're seeing, right? So some providers of capital have more competitive advantages in certain areas. And, as the ecosystem is developing, they're specializing on those, on those habitats that they're really good at. So we specialize effectively on that, on that term loan basis as well. And actually, even within the term loan basis, there are now habitats developing as well, right? So, for example, the private debt funds, there are now lots and lots of them. They're generally much better at the 5 to 7 year, kind of duration of financing, and generally better at the below investment grade side. We found that we're not really competitive on that versus those guys, but if somebody needs 15-year finance, I know that's the complete opposite of trade finance, right? We're really competitive. We're really competitive on IG pricing, right? So if you have, if you have something that we think is an IG type of risk profile, we're really competitive on that. So everybody, it's almost, you could draw a map of who sits where in that alternative or in that financing universe. And you could, if you're a management team and you understood it, you could kind of say, hey, you know what, we're going there, we're targeting that group, or we're actually diversifying our financing so that each group gets a little bit, and then you get really stable financing as a management team of a borrowing company.
Though I would put it, going back to the question or the observation that was made, I don't know any bank that will provide an RCF and an RCF only, right? But at a price where they would normally price them at, right? Because they're normally done at below return on capital or at return on capital, right? There needs to be a mix of things. So you slice off and all the higher yielding opportunities for them, you could end up with nothing as your swing line.
Yeah, RCFs, I agree, are tricky because, again, exactly because of what you say, Matt, right? The pricing of RCFs is through the cost of capital. Now, that's done because of relationship reasons, but then most of the banks, are effectively kind of hoping that it doesn't get drawn, right? Because if it gets drawn, effectively it's dilutive to their return on equity, right? So they manage the relationship with the borrower such that they kind of constantly go like, hey, how are you doing, etc. Any borrowing needs, and they go like, oh yeah, we're going to draw on your facility next week. They go like, oh well, maybe we should introduce you to our term financing team or something like that.
Yeah, I suspect we're going to see changing pricing, by the way, on RCS. I thought,
I agree.
as greater
Yeah.
capital comes in, the pricing of it's going to move anyway.
Yeah.
So how it shifts the mix and package of who provides what part of the facility structure in the way you described will probably evolve in the next 4 to 5 years in any event. We have just a few more minutes left. I might just use the opportunity to put you slightly on the spot, Alex. When you and I first met, Insight had very, very big dreams or vision of how much capital you could deploy into the working capital space. And I'm not sure, well, I'm not going to ask you how much you have put in. That's up to you whether you want to say, but it's clearly not been where you would have originally anticipated.
Absolutely true. Absolutely true. Right. And it is a little bit disappointing for us as well. Right. And I'll I'll tie the RCF comment to, this question as well. The holy grail still is, right, to tie the short-term capital that we also manage, right, to the short-term nature, that, the front end of trade finance brings. So it's public knowledge that we manage, like, I don't know, it depends on the day of the week, right? But it's about 50 billion sterling, of money market funds, right? They are effectively, and the average duration of that money is, around 2 months. That matches on paper brilliantly with the working capital needs, But in practice, how do you get these two to connect? That's the holy grail. Now, obviously, there have been some attempts of matching them, and some of them failed spectacularly, right? But if somehow that can be matched, you won't have a problem on your RCF issues, nor will any borrowing company. But to do that in a way, that is also responsible, and that, if investors kind of want their money back, it's back, right? That's the tricky bit. And then the other bit, away from that really front end RCF, why it's disappointed, I'd say it's generally because of the pricing. So banks are and have been and have remained very competitive in this space. And to be honest, they sometimes price through, the public markets, because the return on equity on some of these for banks and the capital they have to hold is very attractive, and we can't get there. So therefore, yes, the volume is from our dreams. We didn't even realize 10% of our dreams.
Right. I have a suspicion, for what it's worth, as we come up to the hour, that the market, as rates rise and the lending environment starts to change, the market's going to move your direction, right? It's been incredibly competitive bank market for working capital in the last 7 years that I've been running Demica, and we're seeing the first signs of a different involvement in the space now. But we'll see whether it's temporary or otherwise. But thank you very much for joining us. I really appreciate you spending the time. And I look forward to catching up with you in person when I'm next over in the States.
Okay. Thank you very much.